Thanks for joining us once again. This is Greg for Teslafaninsight. As you know, we appreciate it anytime you take the time to like and subscribe, and any comments would be greatly appreciated. One of the big challenges with doing YouTube channels is always finding ways to keep optimizing. And with the more optimization, you have more days that you don't do a show, and therefore we're definitely a few shows behind what we usually do productivity-wise. I am actually, for the last several days, been focused on what's going on with Silicon Valley Bank. And there are some implications when it comes to Tesla. So today, the first thing I'd like to review is, in general, well, what's going on with the bank? Why did it fail? In terms of general information that we have. The second phase of what I would like to cover is the types of responses, first the Fed response, and then an amazing response by many of the venture capitalists who backed that bank up. And then the third thing I'd like to review is, well, how does what's going on with them impact Tesla/Elon Musk going forward? So, as you know, what happened with Silicon Valley Bank is that they went into receivership. Basically, the bank had a certain amount of capital that had been set aside, and once there's a large number of individuals that started trying to get their money out, the amount of money set aside was inadequate to address the liquidations that were going on. So I have to say that I just think this whole situation is fascinating. The biggest reason is that in many ways, Silicon Valley Bank did everything you're supposed to do when it comes to good fundamental banking. But, I want to say the business model got blown up. You could kind of say that, but it also is a story of how the Fed can actually blow out a bank. And so I've been involved in investing, et cetera, for the last 40 years. And it's the first time that I've seen something like this happen. The theory is that if you maintain excellent fundamentals, everything that hits should generally be handled. And in theory, it should be handled in this case. So one of the problems that's happened is that first, let's look at how bonds work. So as you know, bonds don't really work like stocks. So for example, if you have a bond, and let's say that bond is supposed to pay 10% interest. Well, if interest rates actually fall, let's say to zero, like it did recently, all of a sudden you have a lot lower interest coming from that bond, but the price of that bond will spike. So now you kind of make up for the loss of yield in the increasing value of that bond, which to some extent happened as the Fed lowered interest rates towards zero in and around the COVID period. So let's look at the other side of that scenario. So what happened is that an amazing number, Silicon Valley Bank went from $40 billion on deposit to $190 billion in like a 2.5 year period. Now, a weird question that's legit is, how do they do that? I mean, that's a lot of money to move that rapidly to an institution. The answer is obviously they're offering something that drove a lot of investors to come in their direction, and that would be higher rates than other people are willing to offer, and investors could rapidly move their money into that space. So this left us with an interesting challenge. Anytime money can move that quickly into your accounts, it can also move that quickly out of your accounts, which is why I believe, that the come apart happened so quickly, is that, if you have a JP Morgan Chase, a Morgan Stanley, all these other firms, they have huge numbers of corporate clients with huge amounts of capital that need a safe place to head to. And there are all these competitive advantages that the bigger banks have, like, operations globally in hundreds of countries. They handle a lot of services for their customers beyond just investing capital that adds value. So there's a higher incentive for money to stay in because in a lot of ways, they're sort of the outside custodian for a lot of very, very huge companies. Silicon Valley Bank tends to swing towards smaller size companies. So, not as many locations, not as deep a relationship. So there are many reasons why this happened, but according to the research that I've done, the main reason that this occurred is the Fed basically went from 0% interest to 7% interest in 1 year. Now, why is this a problem? Well, the problem is something that we've talked about in our show before, which is, let's look at a retiree. That retiree is looking for capital preservation, and they're looking for current income with which to pay their bills. So the Fed did this thing where they were like, oh, we need as many investors possible in the stock market. And if they're in, the companies will have the capital that they need to grow. So when the Fed moved to those low interest rates, it, if you will, indirectly started elevating the price of, or the value of all stocks within the market, because all of a sudden you just have a lot of capital available, and capital preservation and other folks can't get yield when the interest rates from the Fed are zero. So hence the market was booming. There's a decision made that inflation was too much of a threat to the economy, so we have to reverse everything we've been doing in order to push prices nicely up on stocks, et cetera, which, as you've seen, has cut the stock price of a lot of particularly high-flying companies, Tesla included. So one of the big problems this created was that, let's say you're Silicon Valley Bank and you want to be very conservative with the capital that's been entrusted to you. Well, the move that you would do then is take in, call it $190 billion minus $40 billion is approximately $150 billion worth of capital. And then what you immediately do is you've got a problem going on. The problem is if you sit there with the cash in your accounts, that's the ultimate form of liquidity, so there could never be a run on the bank because you have so much cash available. But the challenge is that those investors potentially come back and say to you, oh, you guys are supposed to be giving me some kind of yield here. So the best move that the bank could do is to go ahead and buy treasuries. So if you buy treasuries and the interest rates are near or at zero, you tend to have to go into longer range treasuries to get any kind of yield if the short-term treasuries are in that zero department. So now you've committed to long-term a fairly low interest rates, and all of a sudden the Fed decides we're going to raise interest rates dramatically. And we're going to do so in a fairly short period of time. Typically not what the Fed does. They may do things, but they tend to graduate those things over multiple years, not 1 year as they did in this case. So this process of rapid rate increase created a problem. There's a large number of, let's say it's the retirees, that need that yield, that 4, 5, 6% perhaps that they could get from the ownership of treasury bonds. In fact, I had an interaction with a gentleman who is kind of one of our advisees, and he informed me that there's something called Treasury Direct. So the in small quantities, 15 to I guess 30K, you could actually buy treasuries and get a 10% on that with no risk. Plus, you don't have any fees from outside firms because you're dealing directly with the Fed. This even exacerbates the problem that I described earlier even further. So I digress. in general, the problem that happens is if the interest rates increase dramatically that fast and the banks are fully committed, in this case Silicon Valley Bank, to owning treasuries, you have basically a disaster on your hands. You, as the rates increased, the value of the bonds was decreasing. So basically, what the bank was doing, should have done, is basically sell all those treasuries that they could, and then use that capital to meet the needs of investors that are wanting to sell out and get their cash and possibly move elsewhere, etc. Well, the challenge is that with the falling value of these bonds, there are these large losses that were being taken by Silicon Valley Bank, and those losses resulted in them needing to go out and try to raise capital in order to meet these withdrawals. And as the news was traveling, things got worse and worse. So in general, the bank went into receivership because they ran out of cash. And once they realized where the Fed was going and the hit they were taking in the process, they were kind of stuck because they didn't have to realize the losses until they actually sold those treasuries. What if the Fed liked the inflation picture and decided to lower rates? Their losses, in theory, could have been lower, but investors didn't want to stick around that long. So, in general, this is a complete disaster for Silicon Valley Bank, as you can see. And so we're now in a situation that I think is totally amazing, fascinating. So a letter just came out from a number of venture capital firms, some of the biggest out there, all of whom are supporting the management of Silicon Valley Bank. And I thought this was amazing because in a bunch of cases you might find poor management, processes, or the CEO ran out of town with a whole bunch of money. None of that happened. The issue was primarily what I just described. You also have issues with money being lent to startups, and those startups using it as part of their operations, and they may have drawn down at the same time that others were just trying to get their money back out. So there's a lot of reasons why the capital would be short, and all of them valid. So we're now in a situation where there's a ton of companies that had on deposit money that they'd been given by VCs and others and in other investors to support their growth and success. And they'll have access to that temporarily, and we'll see how the government deals with this. From what I read in the last situation like this, after $250K that you're allowed, that's covered by FDIC, the last big liquidation resulted in about 50 cents on the dollar going back to the investors. So in this case, because of the nature of what the issue was, I think that we should, in theory, see 60, 70, 80% of the cash going back to investors after the losses I just described are addressed. So I think it's an unfortunate situation. I think it's a really good business model and a bank model that was put together to serve the needs of startups, because the VCs, to some extent, were operating as the bank behind Silicon Valley Bank, because they're raising capital from investors, and then they're investing in companies, and then they kind of back up the lending that Silicon Valley Bank is doing to their startups to some extent. So it's a really innovative form of banking that I hope still goes on, because it allows a lot of companies to exist and thrive. So we're probably going to cover this again to try to dive into solutions that are arrived at, but I just think it's going to be a different sort of liquidation here, because I actually read that a number of the venture funds that may have funds tied up there are now reinvesting in and doing business with the sort of reconstituted entity that's called Santa Clara Bank. And I guess I have to say wow, because that's a vote of confidence. And it's also a vote of confidence because these guys and ladies were kind of running the bank from behind the scenes in terms of how they were working with their portfolio companies and funds that were within the bank and still in the bank. So I just think the whole thing is a huge deal. The biggest Tesla impact I can see currently happening is that the Valley tends to have a large number of big companies that are doing well, and then there'll be a lot of spin-offs of individuals and sort of sections of those companies into new ones that go out, get funding, and get moving. Well, if this whole thing is shut down, and given how high cost the Bay Area is, what I believe you end up having happen is that places like Tesla that might have lost people previously are now regaining people that are very high quality, and they can kind of cherry pick the best people that don't have good alternatives right now. So I just think that Tesla could benefit from this in terms of some great people they could not have hired previously coming aboard as a shelter and adding a lot of value in the short term, even if eventually they may choose to leave. So I think the whole thing is unfortunate. I think the business model that they have and have been implementing for a long time is terrific, and it's made a lot of difference for a lot of companies, creating huge numbers of jobs. So what do I think is going to happen? Well, I think they're going to come up with something that allows a lot of the companies to sort of gain most of their capital back so they can keep investing in themselves and growing. It's just that I think it's going to take a while, and hopefully the while it takes doesn't result in all these companies having to be liquidated, and then, it takes years for it to sort of reconstitute and have these companies have the possibility of becoming huge and successful outcomes as a result. So I very much look forward to your comments on this. I think it's sad to see this happen, but I am definitely rooting for a solution that allows us to keep sort of the vibrancy of Silicon Valley that adds so much value everywhere that it's implemented. At any rate, wanted to thank you for taking time out to join us. This is Greg for Teslafaninsight. Tschüss, German, au revoir, French, Lehitro, Hebrew, Hoda Hafez, Farsi, Strajit, Russian, Nihama, Japanese. And in Jamaica, we say enough respect. Just a reminder, I did my 25 leg lifts and want to encourage you to do so as well. And also work on your stretching of different types, yoga, etc., to make sure that as you age, you don't end up with stiffness in the process. Have a great day, and bye for now. And thanks once again for joining us.